Okay, so first thing first, welcome everybody. And I know some of you guys might be watching this after the fact, or you might just be dialing in to listen to it. One way or another, this is one of the components that Trust Your Talent Academy puts out there on a monthly basis. And it's a free and public event. What we really just want to share with you is because we understand Trust Your Talent Academy stands for financial education through real estate investing. And a lot of the times when it comes to the right investment vehicle that we have picked for us, we also want to get to know a little the bolts and nuts in more details. And a lot of times really it's the experience talk, I think, that really resonates with people. And the fact that theories are great because you can do courses, and at the same time though, when you get out there into the real life scenarios, sometimes this is where the mentorship comes in, or a lot of these conversations need to come in. So with that said, today we're actually very excited to really stir the pot a little bit on a topic called joint venture. And with joint ventures, I think many of you, if you're new, then you will definitely learn and hear about this much more once you get into the creative financing type of courses. However, at the same time, we just want to really share with you collectively our experiences in terms of A, what it is, and B, the who, as we call it, the who, the what, the when, how of building successful, and more importantly, it is an investment venture at every turn. Mutually profitable relationships. Some of these are short-term, some of these are long-term, some of these are really long-terms. And so there are different considerations at all turns. So with that said, once again, thank you for joining us. And we know for a fact that our lawyers love us way more when we literally just have to share with you the fact that from Trust Your Talent Academy, at the moment, we are all what we would call ourselves as educated and professional investors, because every single trainer, mentor, coach on a Trust Your Talent Academy team, we are active investors ourselves. And that is one of the core requirements for every single person, because this is never about and should never be about somebody doing something really great and build a giant real estate portfolio 5-10 years ago. They've been retired, which is awesome. We love that, because a lot of us, we share the same financial status and level. However, we continue to hold ourselves accountable and learn about what the markets are doing, so that when we are actually sharing our experiences, it is still relevant and it is still up to date. And so with that said, we know that some of you have actually submitted questions ahead of time. Okay, so what I'm gonna do now is I'm gonna just let everybody have a quick chance to share where you're from, what brought you here today, and we're gonna get the ball rolling. I think probably should turn off the music at this point. And that did not sound like license free, just so you know. Okay. All right. I see Miranda, Benny. I see Justin, Cam, Mike, Suzanne, Jonathan, and Russell. Good to have you. I don't think we've ever really met in person. However, I've heard so much great things about you. Why don't you share a little bit with people where you're from today and what brought you here?
I'll jump in. Why not?
Okay.
Hi, everybody.
Go
I'm
for it,
John.
John.
John Grant, located in just outside Vancouver, BC. I've been with TYT since last August, and I just try and come to as many of the TYT things as possible, because I find every single conversation just helps add more perspective and insight that, you know, either reinforces what I've already learned or helps me think of something new that I hadn't considered before. So that's why I'm here.
Thank you. Always good to have you here. And I like what you said, though, every single thing that you attend. And this is why, if you look around, anybody, if you look around, you're going to find out that Trust Your Talent Academy, there's nobody else like us. We really truly believe that for those who are serious about learning how to invest, how money works, learning about financial education through real estate investing, it is very much like learning a brand new language. And a lot of the times it feels like drinking from a fire hose and a fire hydrant even. And it really is that consistent effort, especially in the beginning. And that's why the concept of full immersion, it is so key to everybody's long-term success here. So thanks, John. Welcome. And Suzanne, I see you pop on the screen. However, I'm going to quickly, so hi, I'm going to quickly pop back to Russell. All right, is your audio working now? There we go. You came to play. Love it.
Hey, good morning, everybody.
And so you're from, where are you joining us from today?
I'm calling in from the beautiful Coquitlam, British Columbia, just outside of Vancouver. So
Very nice.
primarily do my investing in Alberta, and I just thought I'd jump in here. I was doing some editing this morning, and I got tired of doing editing, and I feel that it's not my best use of my time. And I saw this notice of a group of people coming together, and I always like to sharpen the saw and learn so much. Every time I jump onto these calls, I learn so much from everybody else. So
that's awesome. And I like nothing but respect, Russell, because it's the growth mindset. It's the continuing education. As much
and
as
I lucked
you
out
have
on
also accomplished.
I lucked out on the topic. It's a topic that's near and dear to my heart.
Absolutely. Yep, same here. So welcome. And Miranda Benny, we know you're right here in Alberta. Yes. Jonathan dialing in from Windsor, Ontario. Taigi from Vancouver. Justin from the GTA. And Mike and Cam. Might need you to turn on your camera at some point if you can. Again, we encourage you to turn on your camera just so that we can interact with each other a little bit more. At the same time, if it's a safety concern, just, pace yourself. So with that said, as I mentioned, we want to share with you the session format. Some of you have pre-submitted some questions because through the Eventbrite link, which I'm sure a lot of you have access to, and this is how you got notice of this session. Now, with that said, though, we aim to make this as interactive as we possibly can. We know, there's no more lockdowns, and we love live events. At the same time, we understand that when we do online live events, we can still include more people. And after all, a lot of these coffee chats have turned into kind of a small mastermind sessions now too. So hopefully you enjoy it. So ask questions and share your experiences and share anything that you're currently learning. And then we're gonna talk a little bit about the next steps. And so with that said, first thing first is the fact that, well, one of you, this is actually one of the longest questions I've seen for one of these sessions. So this is regarding season 2 and episode 56 of my Daily Dose with Tim. And I made a video about the real estate cycle, and that was done, as you can see, based on the question. It was done and put out there in October 2021. And for those of you who are not aware yet, I actually started season 3 just this past week. So there are already 5 episodes out. It's out every single day. And every single day I do have a bit of a plan in terms of what I want to discuss. However, it's very spontaneous. It's none of that is scripted whatsoever, very much like this. And so happy to have you there every single day. I go live at noon Eastern time. So coming back here though, since our economy has never experienced BOC's rapid fire interest rate hike since spring of 22, will there be an updated video on the cycle? I'm gonna guess you mean real estate cycle. I don't know who actually submitted the question. I got this from my team and copy and pasted. And so with that said, it's actually my answer is fairly straightforward, and I hope that you find that this is a good answer. The video that I actually did, for those of you, you might want to go back and look for it. It's on YouTube already under the Trust Your Talent Academy channel. Now, an update on that video is probably going to be made sometime throughout this season when it's super relevant and super pertinent, in the sense that the video that I made before is very much, again, it's a collective I would say, experiences and knowledge, and really just observing patterns through decades. And I'm just going to say this, and I'm always very transparent about it. I don't take credit for other people's work whatsoever. This is really just collectively what I've learned from my trainers, from my mentors, from being getting myself continuously educated through different media sources, as well as other experts in the area. So that video, in case you have not seen it yet, go and take a look, and you can definitely reach out to either myself or anybody on the Trust Your Talent Academy team to answer some of the questions that you might still have. However, the cycles are the cycles because all the economic drivers and factors are listed out. Unless there are going to be very drastic changes, even COVID, you could see how it fits into that cycle. The interest rate hikes, you can see how that affects the supply and demand. So for example, right now I live in Edmonton, Alberta myself. We're not seeing much of a spring market, and I'm doing my air quotes simply because first thing first, spring market has always been quite important for the Canadian markets, just because the Great White North. And so a lot of people, they do tend to slow down on the buying and selling movements over the winter time. So what that means is during the springtime, usually there's a bit of a rush. And so in our home market right now, we understand in some other metro cities like Vancouver area, like the Toronto area, things are picking back up. However, if you actually read the statistics, comparing to 2022, 2021, definitely not moving at the same speed whatsoever as we know today. What day is today? May 13th. So it depends on what reports you subscribe to or what kind of information you're potentially getting from a realty brokerage these days. So what that is telling us a lot of the times, and again, feel free to jump in and share your perspectives. This is just one perspective right now, okay? And so we're not seeing a lot of the spring market simply because of the fact that a lot of the people, even if they were to trade up, this is just one category. So trade up or trade down, they basically have stopped those movements for themselves because they don't want to, especially if they're not able to carry the existing mortgage terms over to a new property. So we know that that's been a big issue right now. And clearly the perception for a lot of the typical home owners or uneducated investors or landlords, they are probably, unless they really have to sell, because the values have not gone up as they would have hoped, they're not actually putting things out into the market. So what's actually maintaining the value, even though it wasn't really going up or down too significantly, what's kind of holding the value right now, at least in this market, as far as we know, is the sheer factor from supply and demand. Just not a lot of supply. And so that's actually what's holding the value right now, at least in our home market. And so with that said, though, I always like to kind of illustrate a few things here with everyone. And that's why you see the flip chart here, is the fact that we talked about, I think this is one of the things that I learned really early on as well when I was getting education. And so it is what I think what they call the guerrilla math in a way. And on some level, this is funny because the person that I learned this from, he was very much pro stock trading, or rather buy and hold stocks. And right now, for the most part, we are, as we said, choosing real estate as our asset class to build our income streams and long-term wealth. However, this is why I thought this was actually cool to share, because the way he explained this is that, let's just say that today you have $100,000 in your pocket, okay? $100,000, let's say some economic event happens, for example, global financial crisis or beginning of COVID when nobody knew what was going to happen. All of a sudden, the market drops by about 50%. Your portfolio is now down to 50,000. Can everybody see this, by the way? Almost. Here, let me adjust this a little bit. There we go. So now your portfolio is valued at $50,000. And all of a sudden, you're going to hear it and read it in the news that, oh my God, this catastrophic event has happened. Everybody's investment or retirement is cut in half, which a lot of us have seen and felt the effect of, especially in 2007, 2008, and maybe even carrying into 2009. But then let's say, again, let's talk about COVID, because that was one of the most interesting phenomenons that we have ever witnessed ourselves as investors. And so 50,000 is what it's worth now. But then 6 months later, for some funny reason, people are not fearful anymore, the market's stabilizing, and some other events happened, and all of a sudden, your value or this particular stock has now doubled in value. How much do you have back in your portfolio? 100,000. Okay. However, what are you going to hear about and read about in the mainstream media all of a sudden? Oh my God, the stock market is performing extremely well. It is now bullish again, and most people are seeing their investment portfolio doubling over time. However, what did we start with? 100,000. Where are we at right now? 100,000. Now, obviously, I'm using 6 months as a timeline. However, this is also why it is so dangerous for a lot of people when they are not educating themselves to really understand how the numbers work. Right here, you can already see this person is basically breaking even. There is no gain whatsoever at this point. And this entire process sometimes to take people, not just 6 months, but 3 years, 5 years, 10 years. I've seen people taken over 20 years and still not recovered. 15 years so far, and still not have recovered from global financial crisis. However, though, this concept, taking that into the real estate market, and this is why we always say we like real estate, because it is slower moving compared to many other asset classes, because the volatility on a daily basis is not generally felt nor absorbed right off the bat until there are other economic events that really supports it. What I mean by that is, if you really think about it, let's just say that this is time and this is value right here. Typically speaking, most people like to think that real estate just go this way, right? And that's where the buy, rent, and pray people kind of get themselves in trouble. Why? Because if you actually look closely, this timeline could be over, again, 10 years, 20 years, 50 years, 100 years, 200 years. If you really take a magnifying glass and look at this, you will see maybe things like this. So yes, from a grander picture perspective, if you take the median of every single up and down, and this is what's covered in the video as well, if you take the median point of every single up and down, and then you connect the dots, this is likely what you're going to see. However, this is also why I've already mentioned that next week during one of My Daily Dose with Tim episodes, I'm going to really talk about this and how that line is formed, simply because of the fact that a lot of us can get caught with our pants down, so to speak, when we are just banking on it going up a straight line. But that's the thing right here, is the fact that compared to the stock market, we like real estate. And that's why personally, I have a biased opinion about how real estate, when done correctly, most people can actually get ahead financially, both the short term and the long term. Okay, so what I mean by that is, yes, in real estate, the market might dip. However, because you are able to leverage, so when it goes back up, compared to the stock scenario, you're not going from 100 to 50 and just back up to 100. Okay, so that's what I wanted to share about that. And hopefully the answer is good for whoever asked that question. And so coming back here, I'm gonna, definitely share the stage with all the other everybody else on the call and some of my fellow trainers and mentors and coaches from TYT here. So the second question that we got here is a more general one. How do you draft a joint venture agreement? How do you draft a joint venture agreement? So today I'm also joined by Ray Salazar, co-founder, strategy trainer, and mentor from TYT, Andrew Cowie, a strategy coach from Trust Your Talent, as well as Vince Lee, strategy coach from Trust Your Talent, and Nina Popat from Trust Your Talent, a strategy coach as well. So feel free to jump in, and anyone you want to jump in on and share your own personal experience, feel free as well. So I'm just going to pass the baton over to, I'm going to say, Andrew.
Sure. Yeah. Hello, everybody. Hope everyone's Saturday is going well. I guess the first thing for the answer here, or the opinion on it, would be to just through your networking, talking about other people's experiences with joint ventures. So very high level, trying to mastermind and get an understanding, maybe even before you get to the talk of drafting the actual agreement with a lawyer or whoever, kind of get a better understanding for the options and inclusions that you would likely find in a joint venture agreement based on what some of your colleagues have done before. We always say win and learn. And so if there are learns to go around through members of the community, that is the best way to get started on that before taking the next steps. So that would be my quick input on that, would be to talk a little bit about this to other people as you continue to network first.
Yeah, thank you, Andrew. Vince.
Yes. So when you're drafting a joint venture, I mean, that's probably one of the best ways to scale in real estate investing. We all don't have unlimited amount of capital, and joint ventures is the way that we partner up. And when you're drafting that joint venture agreement, like Andrew was saying, you got to talk to the other parties. You got to have a very clear line of exactly what the party is expecting on both ends, because in a way, joint ventures are very serious agreements, almost, or maybe even a marriage in some ways, because now you're tying the knot. And if the agreements between both parties are not clearly stated, then you could get yourself into some troubles, especially if it's not fair, or it's the power is kind of leaning on one way that you can't get yourself out of, and you tie it for a certain amount of time, then you're kind of screwed. So making sure that the agreements are very crystal clear on both ends, and knowing what to expect going into this agreement is going to be the key part when you're setting it up.
Yeah. So thanks for jumping in. And what I actually want to do right now, because I had a chance to take a look at all the other questions that were submitted. So I think 2, 3, 4, to me, they're all somewhat tied together. And I think maybe we can have a better and more meaningful discussion around this. So how do you draft a joint venture agreement? In my opinion, the quick, simple answers from a structure perspective is, at the end of the day, we like to go through a lawyer, a licensed, currently actively practicing lawyer, to finalize that agreement. However, again, depending on the type of trainings that you have, the type of business currently, or the type of JOBs that you currently hold, you may already have some exposure to getting some sort of a partnership agreement. And that's kind of what it is at the end of the day. A joint venture is kind of like a partnership. Don't confuse that with a corporate structure, though. At the same time, I wanted to share with you a couple of things that we've seen over time. And I'm just going to short form this as JVA. So joint venture agreement. And the way I look at it is there are 2 major components in every single JVA. And the first one is responsibilities and duties. Abilities. You guys know English is not my first language, so I'm doing my best to spell. So responsibilities and duties, basically. And by duties, most of the times we mean management. And the other one is what we would call the money part of things. Because a lot of the times I think, especially if you've taken any sort of courses on joint venture agreements or read any books, I think for illustration purposes, as we know, nothing is one size fits all, especially when it comes to investment deals, as well as formulating any sort of working relationships. Okay, it's kind of like what Vince just said. It's almost like tying the knot. You're getting into a very serious relationship. And if you do think that everything is 50-50 at all times, you might be creating a lot of headaches for yourself right off the bat. However, we like to joke that talking about JVA, and especially later on when we're sharing clauses and whatnot, or just our concept in terms of how we approach our joint venture partners, it's kind of like structuring a prenup before you even get married. And that's really what it is. And at least from my perspective here. And so a lot of times for illustration processes, books and courses, we will talk about 50-50. However, it doesn't mean that between responsibilities and money is always 50-50. For example, I remember when Ray and I first got started, we did have some personal resources, and yet very quickly we ran out of personal resources. So what that means is in order for us to continue to grow and scale, growing and scaling a real estate portfolio, in my opinion, the most important thing aside from making more money, to me, the most important thing on the flip side of that is protection. When you have scale, you can have protection when you are acquiring every single property the right way. Okay. And I've openly shared over the last 12 months between our portfolios in Canada and the US and in the UK, our monthly cash flow actually shrank by over $12,000 at this point. However, the scale has helped us protect all of that. And so I know it sounds really scary for some of you, because I remember when Ray and I first got started, $12,000 a month in passive income, that was more than our financial freedom number at the time. So let alone kind of losing that temporarily for now. Clearly, we are doing other things to fix that at the moment ourselves. However, the whole idea behind this is that you need to be very clear about who the managing partner is, who the money partners is. Sometimes both of you can be wearing both hats. However, from our standpoint, if you're the managing partner, we always like to say 51-49 split on the management part, and then you can discuss the money part. And most of the times, it is still 50-50 that we see. Why? Because for the managing partner, sometimes to react and respond to any issues that come up with every particular deal that you're in together, it basically what you're saying is, let's say you're the money partner. You are entrusting the managing partner to make fast and sound decisions on your behalf when it's required. Clearly, when it comes to the line by line clauses, you can set timelines, you can set dollar amounts, you can set other provisions to guide your decision-making process when it gets to that point. However, just from a starting point perspective, I wanted to share that with everybody. So if you got personal experiences or any opinions, feel free. This is a coffee chat.
We got a question, a follow-up question on that from John Grant. Can lawyers only draft JV agreements, or can notary publics do so?
And you know what? Funny enough, I've never even considered that myself. And for me, paralegals will draft it in a law firm. So yeah, and I know that from another mastermind session not too long ago, somebody else was actually sharing that recently they leveraged AI to draft a joint venture agreement first. They reviewed it, and then they brought it to a lawyer. And so instead of paying the high billable hour rates, the lawyers ended up going 95% of these are good. I'm just going to tweak a couple of things here and there. So I don't have a straight answer for you, John, or no personal experience on that. I don't know if anybody else in the room does.
From my experience, typically when I go to a notary public, it's to confirm I am who I am when I sign, and they look up my ID and they have their stamp, and you're like, yep, Ray is officially there and he's agreed to all this documents, and it's not Andrew posing as Ray. Is typically the case. In terms of drafting new legal documents, it happens in a law office in my experience.
Yeah. Well, actually, on that note, I'm really, really curious about Russell's opinion and maybe experience share.
So is the question about going to a lawyer or not? Is that the question, or the drafting of the joint venture?
So John, do you want to clarify quickly?
So I guess I can answer both. Number one is 100%. You have to go to an expert, right? You wouldn't go to a podiatrist to get your eyes checked, for one. So if you understand that reference, right? So you want to make sure you do that. And the key thing with drafting up any agreement, a joint venture, is the parties, before you go to talk to a lawyer, you need to actually be in alignment with the deal. You need to be in alignment of, and the framework I use is, I call it the 4 M's. Who's bringing the money, who's qualifying for the mortgage, who's the master, and who's bringing the management. So the 4 M's: money, mortgage, management, mastery. And once you have those 4 things clarified of who's doing what, you draft up a letter of intent. You take a letter of intent, which has some top line information, take a letter of intent plus maybe a template of a joint venture agreement. You hand that off to your lawyer, and your lawyer will thank you. It'll be maybe an hour or 2 of their time at the most. And if there's even, I consider on a joint venture agreement, there's really 7 things, really 7 must-haves. It's number 1 is who's running the shows, roles and responsibilities. Tim clearly identified that. Who's doing what in the deal, right? Number 2 is who's controlling the money, who's controlling the bank accounts. Number 3, what's the exit plan? What are the multiple different tiers of exit? Then at the same time, you do contingencies about death. What happens if somebody dies? Those what if scenarios. Who is the approval process of the deal? What is the formula for dividing up the profits? And then the last one is, how is the title going to be structured? If it's going to be all parties on title, one party on title, and how it's structured. So I went over that fairly quickly, but there were 7 things there of that. And those are 7 must-haves on any joint venture agreement.
That is awesome. Thanks, Russell. And actually, just for my benefit, I guess, master. What do you mean by master?
Oh, who's the master? Who's the expert? It's a fancy way of, it's a word that starts with M for the real estate expert.
Got it. Okay.
So master or mastery, like who's
right?
The master of the deal? Who's the expert?
Okay.
And
So
the reason I do that, Tim, is so I can remember it, right? Money, mortgage, management, mastery.
I understand. And so then again, just from my understanding, then in some cases, or maybe even in a lot of cases, masters and management could actually be the same.
But no, it can, but management is more so day-to-day operations.
Okay.
Like, for example, it could depend. Like, you could have a partner that might not be a real estate expert, but they could be doing some of the bookkeeping. They could do some of the other things as part of the day-to-day operations. It's a fancy word of saying operations, really.
Gotcha. Okay, cool. You learn something different every day. Love it. Thank you. Anybody else wanted to share the perspectives? John, was your question answered in that case? Yes.
Largely, yes. I think I was just mostly getting at the fact of whether or not a notary is qualified to sort of do this just at a cheaper rate than a lawyer. That's all.
Just from a legal perspective.
Yeah.
Are they qualified to do this?
Yeah.
Yeah, you know what? Kind of thinking about what they do. I don't know. I'm gonna look into that. Yeah.
Yeah, just curious.
Let's look into that, and then we'll share the response. in the talented group on Facebook, or when this video is posted, we'll do a follow-up comment there so that everybody understands. Now, and this is something that Russell touched on earlier, is the fact that, like I said earlier, English is not my first language. And so the lawyer's job, in my opinion, is to put everything from simple English, where there's common understanding and agreement on, into legalese. That's a whole different language that they speak, that I speak like if 1%, if that at all. And so this is why I think a lot of you, if you've taken, let's say, the lease options course, you understand that there is something that we call the handwritten script. And so, for example, entering into a lease. Now, I don't know where you're from, or your history in terms of, have you ever been a renter yourself? However, I think by and large, who here does not think that if they enter into an agreement to pay something regularly, they don't pay? And so the funny thing is, obviously, the lease agreement, as we see, whether it's a private document that you created through your lawyer, or if it's a provincial template, or in the state you have county templates from within different states. The point is, when we do the handwritten script with our tenant buyers, in this case, because it's a different strategy, let's say entering into the leases, we actually ask them to handwrite in plain, simple English after signing the lease to go, number one, I promise to pay rent on time. Number two, I understand that if I do not pay rent on time, I am in default and could face the consequences posed by the Residential Tenancies Act. Number three, I agree to penalties imposed by my landlord as per the lease agreement signed. Number four, I understand that if I do not renew my lease, it will automatically default into a month-to-month rental arrangement, and all Residential Tenancy Act provisions will apply to me. So all these things we basically write it out. And so kind of turning that back into the joint venture agreement scenario, very much like what Russell also mentioned earlier, and what Vince was saying, is the fact that you gotta align first and foremost. You gotta align. No different than some of you have already done your mentorships as well. When you go out there and when you conduct some of these power team meetings, all you're doing is aligning your goals and business processes to see if there are opportunities for you to grow together. And that's my perspective. And so coming back here is, are you aligning based on financial goals? However, me personally, I think if you've actually watched my other stuff, or have come to any sort of my talks in the last decade now at this point, you understand that, in my opinion, aligning on a value basis is way more important than just aligning based on money and how much money we're going to make and how profitable this particular deal is. Because after all these years, and I know almost everybody in this room, even if it's not a real estate investing deal, the general statement here is life rarely ever goes as planned.
Tim, you also mention a lot that not all money is equal all the time.
Exactly. And so what that means is inherently investing has risks. What we are doing, what we all aim to do, especially when we do invest in ourselves in terms of financial education, real estate investing strategies, what we're doing here is learn how to take calculated risks so that we can minimize our risks. However, risks are always going to be there. And so when you can align based on value, especially value and views towards money, to me, that's way, way, way more important. So I don't know if anybody wants to jump in and, share some experiences about that.
I mean, we have a handful of students here as well. I mean, you guys know, I would rather work with another educated investor who understands the deal, understands the structure of the deal, understands actually what's happening, understands when, if there's a problem that arises, there is more of a common, let's discuss on how to figure this out together, versus somebody who may not be educated, who may not have the experience. Maybe it's a friend or family for the first time, and they don't know exactly what's going on. And when things do happen, it will happen. The problem with somebody that's educated is going to be way more understanding than with somebody who doesn't understand what's happening. And that's why it's like the money isn't equal. Even if they had $1 million, if it was somebody that's going to give me a lot of headache, I would rather not take that $1 million.
100% agree with that. And so one of the things that Ray and I do for our business when we are looking for OPM, other people's money and money partners, is we actually share with them. We buy the books, and we actually, you cannot see this right now. I have a shelf behind the green screen at the moment. We have a stack of Rich Dad Poor Dad, a stack of Cash Flow Quadrant. And what I'm going to start buying now is The Psychology of Money. That has become my new favorite book these days. And we will actually share these books with our potential JV partners, especially money investors, just so that we can have a meaningful discussion. And I know some of you guys might be going, well, what if I got a deal right now and I cannot wait for them to read a book and have a meaningful discussion about it? And so this just is that, like everything else, there's long-term and short-term relationships that you are building. And the reason why I think, kind of like what Russell said earlier also, is that this is a topic near and dear to him, is the fact that when Ray and I got started, we were 27 years old. And even though we were both making decent corporate incomes, we maxed out at 5 deals right off the bat. We maxed out at 5 deals ourselves right off the bat. And so very quickly, when I looked around, the same people that were going through the training with us and doing deals actively to apply what they've learned, is the fact that that's when usually most of them hit that ceiling, because for whatever reason, they were a little too scared, or there's ego, fear of looking bad, to go out and start to raise funds. And that's also why forming joint ventures has been what has created the results that Ray and I have today. And as I just shared with you, and many of you already know this, is the fact that we've leveraged that not just in growing our portfolios in Canada, but also in the US and also in the UK. And I openly share all the times, and as you know, that I think based on today, over 80% of our entire portfolio worldwide is still built based on other people's money. And we're very proud of that, because I don't know if you've seen one of the posts that I shared about joint venture. The way we look at it is simply the fact that once you're educated properly and you know how to find and structure win-win and profitable deals, to me, it almost becomes like a calling, a duty that you have to share the wealth, because we know for a fact that most traditional investment vehicles just don't generate the same type of return as real estate investing when done right, and also real estate as the asset class. And the other thing is, and this is very personal, is the fact that I lost all of my savings investing into a real estate deal back in 2009 because I didn't know what I was doing, and they completely defaulted on me. And that was my hard-earned dollars. I worked 60 to 80 hours a week just to put some money away. Without financial education, I gave that money away, so I only have myself to blame looking back now. Of course, at the time, I played a giant victim. How could they do this to me? But that lesson stayed with me. And that's why when we are getting joint venture partners these days, I share not just the successes, but also the failures that Ray and I have faced over the last 10 years. I mean, 13 years now at this point. And so again, what I'm really also sharing here is, I know a lot of people, you might be a little fearful right now if you need to talk about your failure stories. However, Andrew already addressed that. We either learn or we win. As long as you take the lessons and you are able to share them, let them decide. Because it comes down to your personal values and your personal characters. Because a lot of the times in this environment, because we're not publicly licensed to sell our investment opportunities to the public. I mean, if you want to get that done down the road, that's completely up to you. However, for most of us, we are privately held. And there are certain guidelines and rules that govern that. And so building those relationships, both short-term and long-term, is the key to how you will over time scale and build an income stream so strong that no economic events will deter you, and you will have the wealth base built up over time. And that's why at TYT, I mean, a lot of you have heard this, it's not a get rich quick asset class that we're using. However, it is a get rich for sure when you know how to operate it. Okay, everybody jump in. I feel like I'm doing a lot of talking. I'm just the moderator today. Nina, go ahead. Just jump in.
Hi. Hi, everyone. And can you hear me okay? Perfect.
Yep.
And sorry, I'm not on camera this morning. I just had a couple of things on the go that I needed to get addressed. However, just wanted to talk about this a little bit too. And I'm so glad we are. I know when I first started my journey a few years ago, Nick and I, my husband and I, talked about a few different ways to do it. We had invested in some condos and all of that back in BC and in the UK as well. However, both very, very busy professionals, healthcare, banking, all of that. And the goal wasn't to, we both had different goals as well. One of us myself wanted to transition from healthcare, being a pharmacist, and transition into having more time and figuring out that being a real estate investor, an active real estate investor, was what was going to get me to that vision. And once I isolated on that, my husband, it was okay, we'll buy a property every couple of years and make that happen with our corporate incomes. However, essentially, we both had different ways to do it. I obviously was lucky enough to land on TYT and getting into a fully immersive education program. However, he was like, why don't we just partner with someone and learn it that way? And I, looked at all the options available. And for us, because I wanted to see results quicker, I wanted to learn about so many different strategies. What we came to realize is that JV partnership, although we're going to learn a lot, and of course we've included JV partnerships since then in our portfolio, however, it wasn't going to take the place of mentorship. And so oftentimes when I speak to family partners right now who they invest with us, and we've done, whether it's rent to own or lending on rental projects, they want to be purely passive and kind of learn the off thing. And so we talk about Rich Dad Poor Dad or reading cash flow quadrants, and they get educated to have an educated conversation. However, for people who want to really build a career in this and grow a portfolio in this and learn about multiple strategies, really saying JV partnership is a way to learn, but it's not going to replace a fully, that's not mentorship as well. You can learn a lot, but in terms of learning how to construct a deal, learning how to do your due diligence of contracts, learning how to evaluate opportunities, that's totally different. And oftentimes I think there's a misconception about them being both synonymous. So yeah, just wanted to kind of chime in there with my thoughts. Don't know if that fully makes sense, but yeah.
I totally agree with you, Nina. The amount of people I've talked to that want to just do a joint venture because they want to learn, it's not going to replace mentorship, because joint venture, they have their roles and it's not meant to teach you on how to actually invest or to structure or how to put the deal together. You first and foremost have to know what's going on before you actually do the joint venture. That's going to make things a lot easier for both parties. I can't stress that enough. The amount of time I hear that from people that want to get started. So yeah, I agree with
totally.
you.
And it was actually, funny enough that the first joint venture I did it as a money partner. However, I did it on a rent to own, a lease options, because, and I was able to essentially work with the investor. Both of us worked together. He showed me kind of how he did it. However, I was able to bring up different inputs and ask different questions just because I had gone through the education with my mentor. And so and I was able to figure out how to increase cash flow in between as well. So it helped both of us. And so yeah, I again, I still did JVs as money partner, still learned from it. However, was able to multiply faster and again, fire the boss in a couple of years as well. Right? So,
Yeah.
So thanks, Nina. And jumping in quickly, and that's why education, a lot of the times, in my opinion, it's just theory. And this is why we stress so much about mentorship. And mentorship is also quite different from just coaching. Now, reach out to a strategy coach to learn the difference at the same time, because I don't want to take up all that time explaining the difference between that, because that's not what this session is about. Is the fact that we're talking about joint venture agreements here and joint, how to formulate joint ventures in a way. And during mentorship, what I found personally, because I've hired multiple mentors throughout the year, especially when it comes to real estate investing. Every time we want to apply a new strategy, we hired a mentor. Every time we want to go into a brand new country, we hired a mentor. Now, the idea really behind it is, in my opinion, two major things. First thing first is combining education and your mentorship, you're able to make certain business decisions. Business decisions are quite important because every deal is like a business. And we always say this is why, at the end of the day, cash flow matters. And that number could be big, could be small in terms of on a per deal basis for cash flow. At the same time, it just depends on which income bucket you want to feed into on a personal level. Is it your active income bucket? Is it your passive income bucket? Or is it your long-term portfolio / equity income bucket? However, learning the theory portion, in my opinion, helps you become a bit more clear about how you want to make certain business decisions when you are analyzing or evaluating a deal, whether or not you are the person structuring that deal and actively managing that deal after it's been funded and the property's been acquired. However, the biggest thing, in my opinion, and this is something that I think a lot of people tend to overlook, is your level of risk tolerance. This doesn't come out for most people if they're just taking courses and not have somebody that's done it over time to really guide them and figure it out. And that's why a lot of the times I do share with my students that honestly though, I am more effective over time as a mentor. In the beginning, I will help you do whatever you need to do, but then that relationship continues. So many people in the Trust Your Talent community I've known for 8-9 years now at this point. I've worked with them for that amount of time. They've now built successful portfolios and they've also subsequently become trainers and coaches and mentors on the team for a reason. It's the fact that collectively, we've just figured out everybody's value systems, we've figured out how we operate, and we've also understood our risk tolerance. And that's why as a community, especially a training team, we are able to support each other on their deals, either from a perspective, experience, management, or even financial sense. But as most of you know, just kind of want to share that, and because it's really, really important to us, Trust Your Talent Academy is education only. You will never, ever get a trainer or a mentor or a coach to come to you and say, you're a student, I got a deal, can you fund my deal? Because we believe that that's abusing our powers and we don't want to do that. And that's not what we stand for. And so that I want to make that very, very clear. So internally, students do deals with each other because you're exposed to the same type of training, which means a lot of times there's that certain level of confidence right off the bat when a fellow student presents an opportunity to you, a deal to you, and you can pretty much say, yeah, okay, I think I already know how this person may have found the deal and then analyze the deal and now structure the deal. We just got to fine tune a few things. And that makes things a lot easier for people to move forward with. Okay. Anybody else want to jump in on this?
Yeah. I just want to, it just brought back some thoughts when I like first time starting real estate investing. So complete newbie, didn't know anything, did get educated though. So I did know that part and did have a mentorship. However, when I first did my deals, I didn't really like exactly know everything at the time, but because most of my deals when I first started was with other people's money, joint ventures, some of the people I worked with were a bit more experienced. So they are already educated. And so they had done lease option, for example, as a strategy. So they've done joint ventures on it themselves as well. So when I partnered up with somebody, along with my mentor having my back and whatnot, the joint venture was actually teaching me a better way of structuring it, just critiquing the way that I was doing it, because everything I was doing was right. It's just that he had a little bit more experience coming in as well. And then on top of the mentor helping me, I'm like, oh, I didn't know you could do it that way. Just giving me new ideas. But if I didn't have that education aspect from the very beginning, I wouldn't be able to have that high level discussion to talk about the deal. That's the biggest thing, because as I continue to do joint ventures, I'm still learning and I'm still growing, especially if somebody has different ideas or different perspectives on how to put the deal together. But the conversation now is completely different compared to actually working with somebody who has no background, no mentorship, and doesn't know exactly what they're doing. That's just how I would see it. So when the first time started, a big part of my learning was doing those joint ventures with my process of growth.
I'm actually really curious. By a show of hands right now, you can physically show your hands or you can use the emojis. Who here has not gone through the process of structuring a joint venture formally and legally yet? 1, 2, 3, 4, 5. Okay. Cool. So I'm curious to hear from you because we've been discussing quite a few things. I mean, because if you haven't done it yet, it might seem very high level to you. However, in my opinion, there's already been a lot of lessons and very valuable lessons and wisdom shared. However, if you've never done one yet, I can see how this could be quite abstract at the moment. Do you have any specific questions you want to ask?
Tim, I was trying to write down Russell's 7 things, but he was really fast. So,
well, he's still here, so Russell,
yeah.
feel free I'm gonna write it out too. How's that? So that everybody can copy.
That's awesome.
And I'll just take a picture and we'll put it up on the comments section when the video's posted, so that everybody.
Well, I'll actually, sorry, I'll do something better. So I can't send this to everybody, but I'm going to send this to Ray. I'm going to send. There's 5 areas of a good joint venture agreement. Okay, and there's how many questions in there? There's 6, 11, 14, 17, like 22 questions in there that you need to answer. So if you want to distribute that to everybody, you can. So I'll simplify it a little bit, right? So what you need to do is the simple answer is, oops, sorry, what happened there? I lost my notes. I can't even remember them all myself. So
it happens. I get it.
Hang on. Oh,
things that we've been talking about for years, all of a sudden it's like, where did it go?
I got multiple screens going on here, so hang on. Okay, so the simple thing is it boils down into the 5, let's call it 5 buckets. First one is management, right? Who's going to be the manager of the deal? Who's doing what, right? Is there, a way? How do you remove manager? What are the roles, responsibility? Are there management fees? All those kind of things. Like, so who's really managing the deal? Okay. The second one is the exit clauses. How do you get out of this? You design the divorce in advance. Before you even get in the front door, you need to know how you're getting out. right? What are the different exit clauses? You know,
Like
first
the
right of
prenup.
refuse. Pardon me?
Like the prenup.
Yeah, absolutely. Like, you know, first right of refusals. What are the timelines? Is there a shotgun clause? Is there a forced listing, sale? You have all those things for everybody as well. The next you want to determine is cash calls. You know, you establish who puts in the initial capital, and then you decide after that how the additional capital is handled, right? And then you also have to answer the questions about what happens if somebody isn't going to contribute. What happens, you know, if somebody won't put the money in? How do you do those things, right? Then you want to talk about defaults, like what happens if somebody is defaulting on their obligations to something like that. And then the last one is profit distributions, right? Meaning who's putting in the money, how is the money going to be redeployed at profit time? And also one of the things that trips up a lot of people is how is money divvied up at refinance as well, which can be different than disposition as well. So really 5 buckets there.
Awesome. Thanks, Russell.
Yeah.
And
Thank you, Russell.
Thank you, thank you. And for TYT students, you understand that everything here is also taught at the creative financing course too. So love it. I remember reading your book way back when now, Russell. I don't even remember the year I picked it up. It's awesome. So again, as a supplementary type of, or some people would just call it a sales aid. No different than us sharing Rich Dad Poor Dad or Cash Flow Quadrant, and like I said, now the psychology of money. Perhaps grab a copy of Russell's book, and that's what you will share with your potential joint venture partners. Okay, after all, we are growing together, and that's the whole purpose of it.
We have a follow-up question from Ken. And he's asking, speaking on JV, you like to work with educated investors. Is there also a personality profile you develop over time to help choose a conducive JV partner?
I love the question, Ken. I mean, the funny thing is, I'm gonna guess, I don't see your face right now, so I'm gonna guess that you have not been exposed to a lot of Trust Your Talent events yet. One of the core trainings that we do is a boot camp or a workshop, and we actually go into personality profiles so that's part of the entire process. So there's a lot of moving parts. I mean, everything here, as you know, this is why this is part of the creative financing course. And then we also have a course called Raising Funds. And actually there are 2 different levels for raising funds as well. And that's once you understand the mechanisms, the hard skills of structuring this and speaking to a joint venture agreement and the clauses within, how do you actually speak to them so that you will successfully get the money? Okay, I mean, that's the long and short of it. And so we do go over personality profiles, which, by the way, I was just informed that if you've heard of the personality test called DISC, D-I-S-C, it is now officially public domain. So I wasn't aware of that until yesterday, actually. So feel free to leverage that tool, or once you've actually gone through some sort of TYT training, you will also get a different type of personality test and profiles that you can leverage. Because again, if you just want to break it down into 4 different types, it makes it a lot easier for you to actually speak the language with your potential joint venture partners. Because I think a lot of us, we were brought up to treat others the way we want to be treated. However, I think we want to share at this point out loud and proud that you want to treat others the way they want to be treated, especially when you're raising funds. And for those of you who are kind of geeky about this, Ray and myself, we actually did another training, and it's called the Enneagram training. Instead of 4 personality types, there's actually 9 different types and 16 subtypes. So you can really dig down into it. Again, only if you're geeky enough like us to do that. The point here really is, though, when you are raising funds, because you can see we kind of departure a little bit from the joint venture agreement or the creative financing side of things. However, really, to me, they go hand in hand, because one's a hard strategy, hard skill, the other one is a soft skill and soft strategy. Is the fact that you want to be able to speak to them the way they like to be spoken to. And also that way it helps you break down the different clauses that you have in mind. Because over time, an active managing partner typically will have some sort of a template of a joint venture agreement. When you're working with another educated investor, chances are you're just aligning your joint venture agreements that you've already made up. However, you might from time to time have a family member, have a best friend, have a cousin, have a coworker, or have an aunt or uncle that want to say, you know what? I've been watching you for the last few years and you haven't gone bankrupt yet. That's a good thing. So I'm ready to jump in with you. At the same time, though, what are they jumping into with you? Okay. And this is when you really have to pull out some of those tools and skills to speak to some of these clauses in a way that in our opinion, in our perspective, non-educated investors. So they do go hand in hand. Creative financing, raising funds, creative financing, raising funds. I mean, some people like to just call it sales. I mean, I don't like to call it that, or even when I do call it that, I mean, the word sales, in my opinion, is you're adding value to other people's lives. And you're also leaving the decision-making in their hands. I think a lot of us, especially private, smaller investors, especially if we're at the beginning of it, our biggest fear has always been, what if they say no? Well, then next. It's okay. And then you take the lessons and learn if it's a skill shortage or a mindset shortage. And that's what TYT is here for. And that's what the mentors are here for. So anybody else? Wow, it's very, very quiet room. Hang on a second. I realized I got eight messages that I've missed so far. Okay, there we go. We just got Ray helping us with notes. Yeah, go for it, Precious.
Hello. So I was just listening in, and the question that came in about the personality types and raising funds, and it's just the thought of it basically because being an active partner in real estate, we've gone through all stages of everything going right, everything going wrong. So it's like, yes, having the right JV partner is crucial, because if you get to the point where everything is going wrong and you don't have the right partner, they probably won't stick it with you, and that's why again, understanding who you're doing your project with is very important. Being transparent with them is also very crucial in this game. So I just wanted to share that really quickly.
Thanks, Precious. And I know you're a little too humble right now. However, for those of you that don't know, Precious and his business/life partner, Liz, they officially declared financial freedom last year at our annual conference in Toronto. And they started their training in March 2020. So at the beginning of lockdown, they decided to start learning financial education. And Precious, your acceptance speech is what hit me the hardest. Is the fact that you did share with others about your financial situation when you got into the training. And then 2.5 years later, you declare financial freedom. And it's simply because, like you said, every single dollar so far on how you've been able to build your portfolio, free yourself, and help others share the wealth is through OPM.
100%. Yeah.
Yeah.
Yes. Yeah.
And so I know this topic is also very near and dear to you because you've built yourself from the ground up with mostly JVAs and private lending. So I just want to I know you're too humble to share that. So I want to share that for you because I'm super proud of you and super happy for you.
Thank you, Tim.
Yeah. And so, like I said, I know, some of these things may sound really, really high level. However, I think most of us are picking up the idea of, yes, Hard skills, great, whether it be raising funds or knowing what clauses to put in there. At the same time, really, it's the who. And by who, we mean, are you aligning based on values and goals when you're working with your joint venture partners? I know that even for myself, I had, and I really use right or wrong. I do believe most things work on a spectrum these days. However, I know that I had the wrong mindset, thinking that uneducated money is the cheapest money. Turns out 13 years later, after a lot of OPM, uneducated money is the most expensive money. And so a lot of people, they also are wondering, well, you know what? I've got a pretty decent job. I don't need to take the courses. I just want to park my money. And that's also fine. Do I really need to do this training? My biased opinion says yes, 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 and 1,000 times yes. Why? Because it is ultimately financial education that you are getting, so that once again, as I mentioned, you make your own business decisions, figure out your risk tolerance so you can decide what kind of deals you want to jump into. Because whether or not you want to become, and this is also another question that we get asked so much, I make good money. I don't want to be an active investor because that's taking on another job. I don't want to do that. I just want to be an armchair investor and be passive about it. Well, sure. However, in my opinion, you still want to get yourself educated. Do you need to? That's your decision, not mine. Clearly, I'm already very clear about the fact that I'm very biased. However, if you're active or passive, you got to learn how to protect yourself. And this is why a lot of the times I do joke about the fact that many of you know this. I've had 3 heart attacks in my life. And that didn't shape me up to learn financial education. Losing all my savings made me want to learn how money works. You see how twisted that is sometimes? But that's my journey. So, yeah. Anybody else wants to share a few more things or any other questions? Wow, we're all super, super quiet today. Okay, so then what I want to share quickly with everyone here today next is the fact that we've got a few events coming up. And once again, as I mentioned really, really early on in today's session, we believe in full immersion when it comes to learning about financial education, leveraging especially an asset class like real estate. We have events happening every single week, both public facing and internal paid events. So how to get started? Talk to a strategy coach. I know Ray's already posted a link. Talk to a strategy coach to get yourself started, even if you're just a teensy bit curious. Okay. Now, next weekend, though, we know it's a long weekend. However, we are doing our very first live workshop in Edmonton next weekend, and it's over Saturday and Sunday. Monday, you still have a day off, most of you, so that you can bounce back. I remember, you know, when Ray and I were getting trained ourselves, this is back in the beginning of 2010 now, for a couple of years there. We remember sacrificing holidays, long weekends, birthdays, anniversaries, just so that we can drive or fly to take courses. And we want to make sure that you still have a day to bounce back, because I remember we were basically going to zombie mode sometimes just to do courses to get ourselves trained up. So we want to make sure that we deliver the content materials in a way that is sustainable, and also you will continue to get ongoing support with the strategy coaches too, in this case. So we have a live workshop that's geared towards usually people that either have just thought about learning how to invest in real estate, or maybe you got a couple of properties already under your belt and you're really wanting to be strategic about it to scale up and grow. And at the same time, there are also advanced live courses. The 2 strategies that we're offering, first one is lease options as exit strategy. We clarified that simply because lease options can also be leveraged as an acquisition strategy. And funny enough, because the weekend after, I'm actually going to be speaking at the multifamily conference in Toronto. And so we can share those links as well in case it's something that you are curious about attending or want to attend. And I'm going to be sharing with everybody how we leveraged lease option as an acquisition strategy to do our very first deal in the United States. And that was a 144 lot mobile home park. And so that's why we always make it very clear that when we're talking about lease options, is it an exit strategy or is it an acquisition strategy? And then we have income properties, multi-unit residential happening on the same weekend too. And so for some of you, if you want to come out and meet the TYT community, as well as some of us, these are the TYT Connects that are open to public that you can register for. Most of these events, because of locations, we have headcount restrictions. Okay, and Kitchener, Waterloo, Cambridge, and London, the locations have actually just been confirmed. So make sure you check Eventbrite so that you know exactly where they are. Okay, so come out and meet us. Just because today's session is online live, it doesn't mean that we are not real people. We are more than real. And we've been around for quite some time now. And so, oh, hang on a second. I don't know why there are two right here. And for some of you who want to know a little bit more about what the life workshop is, basically it is 2 full days, 16 hours, or maybe more. I'll be training that class next weekend, actually. We're gonna start at 9 a.m. We're gonna finish at 6, both Saturday and Sunday. And remember, on the Saturday after this class, stick around for TYT Connect as well. And what you can expect, really, as I mentioned earlier, there's hard strategies and soft strategies at the same time. And because there are 2 days, we're going to focus some of the fundamentals that we believe are very, very important for all investors. And so with that said, there's going to be small group discussions because it's really, really boring to just hear somebody talk for 2 days straight. And I don't particularly love my voice that much. So, you know, that's not what this is about. It's about making sure that you are learning and, more importantly, retaining as much education as you possibly can. I'm going to be joined by a lot of the strategy coaches on the team and the trainers. So there's going to be theory coupled with what I think what's more important is the real life experiences and stories, so that a lot of what you're learning is going to stick. And we're going to share some contract templates. The biggest value of that will be cutting down on your billable hours if you had to start from scratch with a lawyer or with a paralegal person. And we're also going to share some scripts on raising funds. Now, that's the thing about sharing scripts, is that we're going to actually walk you through how to make it come to life. Because a lot of times what I found, especially as a student before, okay, sometimes I feel like, you know, one of those, like for example, Kelly Clarkson, she is now a coach on a singing competition. And she will always say, I know what you're going through because I've been you. And that's exactly our perspective. Everybody on the Trust Your Talent training team, we've been you. And so everything that we're sharing with you and teaching you and training you on, we've been through that process. And so it's not just about, hey, you know what, here's a manual, here's some scripts, go for it. I know some people really like that. However, we want to make sure that you learn how to make these things come to life so that you can actually use them, because this is about how applicable you can be. After all, knowledge is no longer power. We live in the information age now, and information is cheap, just like talk is cheap. Take action, do something about it, okay? And then we're gonna share the course materials recordings. There's going to be scholarship opportunities at the event, and also core courses that we're gonna be sharing with you. And after that, you get to attend unlimited numbers of online boot camps this year, just so that you can stay close to the fire and continue to sharpen your tools and mindset as an investor, okay? And so with that said, we've priced it at just about $10,000. However, for those of you who are in this session and have never taken a workshop or a boot camp with Trust Your Talent yet, our launch special, because it's our first time in Edmonton, is $199.99 per person. This is your early bird special that will end. That will end by Monday. So make sure you get yourselves registered. And I understand a lot of the times you're going, well, I don't want to go alone. I want to bring my spouse, my best friend, my cousins, my coworkers, or my current business partners, because we want to explore another business venture together. It is not $199.99 times 2. For every additional person that you bring, they only pay $100. So for example, we've had families, mom and dads going, you know what, I've worked my tail off my entire life. However, we got 3 kids and it's been really, really difficult for us to save anything or to pass on anything as a significant amount of inheritance. However, we now see the value of financial education. So a family of 5 might do this together, okay? So that's how you can look at it as well. And with that said, register now, scan the QR code, complete the registration, and we're gonna see you there next weekend. So on that note, I know we already talked about education versus mentorship. A lot of the times, everybody's situation is different. Actually, most of the times, everybody's situation is very different. And that's why we keep saying your financial goal, your financial path, your financial learning journeys is not one size fits all. So certain strategies from a theory perspective, you might all learn together. However, in terms of actually how to make that plan, that path that's tailored to your situation, because again, factors like age, factor like current resources, or factors like life and professional skill sets right now can largely change how you get to your end goal. Personally, over the last almost decade now, as a mentor around the world teaching this subject, I've had students as young as 17 years old and somebody that's got as much life experience as a 60-something years old. And so clearly the goals are very different and the amount of time they want to achieve those financial results are also very different. And so this is where you need to actually have a very open and honest and transparent conversations with one of the strategy coaches on the team, because we don't believe in one size fits all, okay? So if you like to do that, this is how you can do it. There's a QR code right now on the screen. So take a screenshot, take yourself to that page. You're going to be able to make an appointment directly with one of the strategy coaches on the team now. So I understand that many of you on this call right now are current Trust Your Talent students, so don't worry about it unless you got other questions that you want to chat with them about. With that said, for all upcoming events on our Eventbrite page, there you have it. And to make things a lot easier for you, just make sure you follow the Trust Your Talent Academy Eventbrite page so that you constantly get updated on all public events as well. Okay, with that said, some of our social media presence, I know many of you already following us, that's why you're here. I can see that we have about 5 minutes left against our schedule time. So how about we do this? Any last words, comments, shares, ahas? I don't know about you. I'm almost done with my coffee. So that might conclude this coffee chat pretty quickly before I make another cup.
I would like to say something.
Go for it, Suzanne.
As far as the joint venture contracts, I got to thinking when just listening today that, when you say it's a lot like a marriage, that those of us who just absolutely really love people and we like people to be happy and it brings us joy, it can be a little bit tempting to, when you're drawing up your contract and compromising on items, to mistake compromise with giving your JV partner what they want and forgetting about your own needs. Right? So I think that's something to be careful with.
Definitely something to pay attention to. And and from my perspective, though, thank you for bringing that up, Suzanne, is the fact that I always say that looking back on my own life and my own career so far, both as an investor and before working in the corporate environment, is that I'm the happiest when I can help other people make money. At the same time, though, remember, one of the 5 core values at TYT is what? Sustainability. If you want to help others in the form of a charity, go and set up a charity. However, you're in it to create a profitable business so that you are sustainable in the long term, and you can use your profit to do the charitable work that you would like to do down the road. So to me, it's almost kind of like really making sure that you have your priorities, both short-term and long-term, in sight. And in your particular case, make sure you constantly reach out to your mentors. Okay, your mentors are not your accountability coaches. That's the thing. I want to be very clear about it. If you need help, reach out. They are there for you, to guide you, to support you. Okay, so I love what you're bringing up there, because yes, and this is why, you know, sometimes you've probably heard me share this now because you've been around the community for a long time, Suzanne, is that in the beginning, in order for me and Ray to grow and scale up and grow our investor database, we were sometimes giving away the farms. So we've gone from maybe even giving away 80% of the profit per deal to now keeping 80% of the profit per deal. However, it wasn't always 50-50 from the beginning. And you know what I mean? And so it really comes down to the individual conversations. And, you know, we'll assess it, help you assess it one case at a time. However, bottom line is, we always say money will follow good deals. And that's why, as an educated investor, our job is to really locate good deals, make sure that we stress test it through the deal analysis process, do our due diligence properly, come up with a structure based on the value conversation and financial goal conversations you've had with your investors. Then we can start to marry money to our deals. That's when things happen.
Absolutely.
Yeah. Awesome. Anybody else? 2 minutes. I know it's Mother's Day weekend too. Anybody's got good, like big plans for Mother's Day? I see a few mothers in the room.
I could not get anything booked. Everything's already booked up. As for what you mentioned, you should do it now, not to it. But I do want to speak on something you mentioned about like giving away the farm. I think a lot of us, when we first get started, we feel that, oh, who am I to, you know, deserve a 50% cut on this? You know what I mean? I think we've all been there, especially the ones that've been educated. I know, Precious, we've had a talk one time, you were going to give 70%. I'm like, why? And he's like, well, I don't know. I need this. I think, I'm like, do you know what value you bring to the table? It's like, you got to really understand what your worth is, what your value is, because you took the time to get that education. You took the time to learn. You took the time to invest in yourself, and you actually brought everything to the table. Yeah, they maybe bring the money, but so what? I could find it somewhere else if not yours. So know where your worth is, know where your value is. Precious.
Yeah, and Vince, and I think again, it's even looking at it. If you're looking at it on when you're acquiring it, oh, this is just what I think I'm putting into, but it's a long-term thing you're going to be doing. And at some point you'd be doing a lot more work than you thought you were going to put into it. So you'd be reevaluating and saying, oh crap, I guess I should have not done less than 50%. Right. So it's a long-term thinking as well on that.
Yeah.
Yeah.
Yeah, love it. Well, thank you again, everybody, for joining us for today's coffee chat. And this is a public forum. So maybe you were shy today. I don't know. But next time, feel free to speak up more, because we really want to create that environment, albeit online, that we can really trade some notes and share some experiences and grow together. Okay, so have a great rest of the day and an amazing Mother's Day weekend to everybody, especially if you're a mother. Happy Mother's Day. And we're going to be back here in June. So pay attention to our Eventbrite page for the next monthly coffee chat, amongst other seminars and bootcamp and workshop schedules. With that said, live well, everyone. We'll see you next time.